Exercise 9-12 has two kind of challenging concepts: calculating interest income and accruing for interest income. Remember, interest equals principal times rate times time, and the challenge is that we're almost always given an annual rate, but we have to calculate the interest income, in this case, for a period of less than 1 year. So let's do exercise 9-12 together. On April 1st, 2012, Shatner Company says we can't pay you the $20,000 we owe you on our accounts receivable balance, but we hopefully will be able to pay you within the next year. So we accept a note in settlement of that account receivable. This gives us a piece of paper that says that they owe us $20,000, and it also allows us to charge them interest. So accounts receivable is an asset. Assets increase with debits and decrease with credits. So what we're going to do is we're going to credit accounts receivable for the principal balance on that note. We're going to instead turn it into a note receivable. A note receivable is also an asset. Assets increase with debits. So we debit the account notes receivable for $20,000 and credit accounts receivable for $20,000. On July 1st, we lend some cash to Richie Rosenberg. We're going to charge him 10% interest. Notes receivable is an asset. It increases with debits, so we debit the account notes receivable for $25,000. In this case, we lent him some cash, so we're going to credit the account cash. Cash is an asset. It makes sense that it would decrease with credits. All right, we're kind of lazy in this company, so we don't accrue for interest income every month. We wait till the end of the year. So first, let's accrue interest on the Shatner note. That's a 12% note on $20,000. So interest equals principal times rate times time. So we're going to debit interest receivable and credit interest revenue. And how did we get that $1,800? What we did was we took the original principal of $20,000 times the rate, which is 12% or 0.12. Then what I always do is figure out how much it is per month. So I divide by 12 and then multiply by the number of months. In this case, they owe us for 9 months, from April through December. So I multiply that monthly number times 9, and that gives me the $1,800. We also have to accrue for some interest revenue on the Rosenberg note. In this case, it's $1,250. How did we get to $1,250? Same concept. Principal times rate times time. In this case, the principal is $25,000. The rate was 10%. And like I say, I always like to figure out how much it is per month, so I divide by 12. And in this case, we lend him the money on July 1st, so he owes us 6 months worth of interest revenue. So I debit interest receivable for $1,250 and credit interest revenue for $1,250. All right, we get to April 1st, 1 year after we turn that Shatner note into that Shatner account receivable into a Shatner note. So we're going to have to take that interest receivable off our books and that note receivable off our books and book some interest revenue for this year. So what does this journal entry look like? First of all, let's start with the credits. We credit account receivable for the principal balance of $20,000. He also pays us in full, so that means that we take this interest receivable off our books. That's the interest receivable we booked at the end of December. But he still owes us for 3 months worth of interest during the calendar year of 2013. He owes us for January, February, and March. So we took the $20,000 times 12% interest, divided by 12 to get the monthly, and multiplied times 3 to get 3 months, and that's how we end up with the $600. So the credit side of this journal entry has the principal, the interest we previously booked as revenue in 2012 and previously accrued for, and then this new interest revenue that we have to record for the year 2013. Same kind of thing happens on the Rosenberg note, but he dishonors it. So we have this tradition in accounting that we turn that thing back into an account receivable. So the debit is to accounts receivable, and let's look at the credit side. The credit is for the balance, the principal balance on the note of $25,000. The receivable that we previously booked on December 31st, remember we booked $1,250 worth of interest receivable? Well, he's dishonored that, so we're going to credit that account. And then we also have to book the interest that he owes us for the month of, for the year of 2013, which is 3 months, January, February, March. So again, $25,000 is the principal balance times 10%. Divided by 12 times 3 gives us $625. So the credit side of this journal entry has the principal, the interest we previously accrued for, and then 3 months, 25,000 times 10% divided by 12 times 3 to give us the interest revenue that we have to record for 2013.